Okay, thank you, Stuart, and good afternoon to all the listeners. So for the next 15 minutes, I'm going to discuss undervalued suburbs, and I'll be outlining the relevant characteristics and provide you with some examples. So first off, you'll recall when you were registering for this event that we asked you to provide your opinion on which suburbs you believe to be undervalued in Melbourne at present. So this table outlines your responses, and the entries in bold are ones that have received multiple mentions. And by your responses, by and large, you've pretty well demonstrated that you're a fairly cluey bunch, as many of these suburbs have some, if not all, of the qualities of an undervalued suburb. You even picked a few that I'm going to have a discussion in a bit more depth about in a few minutes' time. Okay, so before we do talk meaningfully about undervalued suburbs, we need to address the issue of hotspots. I'm sure you've all heard and seen numerous mentions of hotspots throughout various forms of media. Some commentators are absolutely obsessed with the hotspot phenomenon, and you'll have also seen with some of the glossy investment magazines out there that they focus on it fairly heavily as well. Hotspots are the property investment equivalent of the latest fad diet that you'll see on the front of a women's magazine. Of course, there's always a headline-grabbing cover, as we can see here. So this afternoon, we're going to well and truly extinguish that hotspot flame. So let's start by clearing up the difference between a hotspot and a genuinely undervalued area. A hotspot is typically a whole suburb experiencing short-term price growth, and the assumption of many buyers is that this makes it a great investment. A hotspot can also be fashioned by the prophecy of a single commentator or perhaps even a journalist based on just one or two superficial positive factors, such as perhaps transport linkages that may have been improved, or the rise of a local industry, or perhaps even the proximity to another blue chip suburb nearby. Sadly, the reality usually doesn't match the hype. Whilst the hotspot suburb may have only one or two of the necessary infrastructure factors that drive consistent demand and growth in a prime residential area, such as perhaps a train station or a new freeway, they just don't tick all the boxes required. Too often, the initial rise in prices that attracts the interest of the hotspot commentator is artificial. It's been driven by new housing projects which the developers sell to buyers at a premium to the going market rate for the area. And this, as a result, skews the underlying values across the rest of the suburb. Unfortunately, a few years down the track, when owners of these recently built properties decide to move on, the resale price can frequently be below the original purchase price. Key quality of life factors, say access to public transport, a local shopping centre, and proximity to cafes, restaurants and other leisure activity, often turn out to be sparse and dispersed, and so new residents can quickly become very disillusioned with the area. Hotspots may be cheap, but because various commercial or industrial activity adversely impacts the residential amenity. Sadly for the hotspotter, these businesses are chugging along nicely, and there is very little prospect of a commercial exodus in the near future. This, of course, holds values back, or at the very least, makes them somewhat volatile. One of the qualities we look for in is a relatively consistent streetscape. And now this is generally more art than science, and the benchmarks do vary across locations throughout Melbourne. In blue chip suburbs like, say, Hawthorn or Albert Park, one might demand a near uniformity of property type in terms of the streetscape. But in a more eclectic place such as Fitzroy or perhaps Brunswick, which have a history of mixed residential and industrial uses, you tend to be a little more forgiving. However, a street that is a hodgepodge of architectural style, building types, uses won't appeal to the vast majority of buyers or renters. So we're not interested in that type of location. What we know about hotspots is that it starts with affordability, but never really looks into all the determinants of long-term capital growth. So an area may get a boost from an influx of first home buyers who require lots of accommodation at a very low affordable price. But for anyone whose criteria goes beyond a low price, the area generally won't appeal. Consequently, the area doesn't sustain its initial growth.
So Jarrod, maybe give us an example of the types of places that are promoted as hotspots.
Yeah, good question. People do tend to get very excited, Henry Stuart, when you have perhaps a new freeway is announced or completed. We definitely saw this with Eastlink. Suddenly Ringwood, Frankston and every town or hamlet down towards the Mornington Peninsula was seen to be taking off. But the reality is that whilst a new road may reduce or commute by say 10 or 15 minutes, the residents of these areas still face 90 minutes or so commute to the city. The infrastructure improvements are generally not enough to make them a game changer. But if you contrast this with, say, areas like Kensington and Flemington, which are close to the CBD, and generally have very good shopping and public transport, and have many tree-lined streets full of Victorian and Edwardian-era cottages. Now, for many years, these were sleeping beauties, but somehow it hadn't taken off at all. What we found, though, was that the trigger came with the closure and the redevelopment of the stockyards in the late 1990s, and then in the early 2000s, the opening of CityLink. And as a result, all of a sudden, the commute to the CBD became a lot easier, and absent the meatworks and the abattoirs in the area, they started to become a lot more in demand. The other thing that really drove that was suburbs like Carlton and Fitzroy becoming a bit more unaffordable, and people looking for some form of affordable opportunity. Another classic example of the hotspot is a mining town. So towns like Gladstone, Bowen and Port Hedland, just to name a few. And some of these locations have seen great levels of capital growth in recent years, as they struggle to accommodate the influx of workers required to construct new or expanding mines. But as we all know, the mining boom at present is starting to fizzle out. Many of the mining sites associated with these areas have transitioned from labour-intensive construction phase to the highly automated extraction phase. Property prices in these areas are suffering now that the construction workers have moved on, and what you do tend to then find potentially is that not only are you not able to get your price back, but you actually can't sell the property at all because the demand's just no longer there. Okay, so let's turn our attention to the undervalued suburb, and in truth, it's not really about the whole suburb, but just more a precinct or a pocket of that suburb. An undervalued precinct is often a section of a suburb or even just a few streets perhaps, but rarely an entire area, and immediately adjoin a prime high-value suburb. These precincts have all the characteristics underpinning demand and growth, not just one attraction like relative affordability compared to adjacent high-value suburbs. These precincts have all but one or two of the critical infrastructure factors and are about to have a critical one added to complete the picture. They sometimes have obsolete industrial or commercial buildings for a classic architectural style, which are ripe for reassignment to residential use, leading to higher values in the future. Think Victorian-era brickworks, breweries, or even warehouses. Moreover, the course of a deindustrialisation of these areas is nearly complete in these areas. The exit of industrial or commercial uses raises residential amenity and values with it. The local shopping strip for the potential for a village-like atmosphere that is growing in popularity or is likely in the immediate future. The precinct displays significant architectural consistency, which is true scarcity value. That value is embedded in the existing property stock in these precincts. The key is usually renovation, extension, or appropriate redevelopment within those spots. It's also a variety of existing infrastructure, public transport, healthcare, and so on, that can be upgraded and intensified. And the first home buyers and upgraders who are buying into these areas have the resources to upgrade their properties. They're inspired by the older style or period dwellings and are willing to spend money on revitalising the buildings. So where do these undervalued parts of Melbourne? Well, let's take a step back and just have a look at a map of Melbourne to start with. The area in the green is our patch, so this is where we buy 99% of our investment properties. It encompasses the inner eastern suburbs, the inner bayside suburbs, and also the inner northern suburbs and northwestern suburbs. The undervalued suburbs we are going to discuss this afternoon are mostly in areas that we do invest in. So by and large, the suburbs contain properties that meet the benchmarks we set, so i.e. properties that will deliver strong and consistent capital growth. But, and this is a big but, in the undervalued suburbs, these little pockets are relatively rare. Okay, so we're going to start with Ascot Vale. It's 6 kilometres approximately northwest of the Melbourne CBD. It's bordered by Maribyrnong Road to the north, Maribyrnong River to the west, Flemington Racecourse and the Showgrounds to the south. As a suburb, Ascot Vale was established in the 1880s, and as its name suggests, it's heavily linked to the equine and horse racing industry. There was actually a second racetrack within the suburb called Ascot Racecourse, which was situated just below Francis Street. This was demolished just after World War II, and as a result, they redeveloped it for housing commission flats and houses. One of the key features for Ascot Vale, it's got fantastic access to the city via trains, trams, and definitely road access as well. The local village, which we're always focusing on with investment grade suburbs, Union Road is a fantastic has a really good village atmosphere. It's really gentrified noticeably over the last 5 to 10 years, and has got a real variety of shops, cafes, and restaurants.
Jarrod, I've got some clients that own property in Ascot Vale. Admittedly, most of them own-occupier, but how does it stack up from an investment perspective?
It works well in parts, as with most investment suburbs, Stuart. It's never across the board that this is the right suburb. It's picking the right pockets, and Ascot Vale's no different to that. So if you look at the map on the screen, proximity to Union Road and to the train station are very important with Ascot Vale. So the Rothwell Hill section on the eastern side of Union Road that goes up to the train station is highly desirable, particularly towards the northern end up towards Maribyrnong Road. But there are some very good pockets just west of Union Road as well. We just don't want to go too far west, because then you are getting too far away from that public transport and also potentially from the cafes, which, as I said, are very much an important part of the lifestyle in and around there. Currently, median house prices in Ascot Vale sit around $900,000, and for a unit, it's around the mid $500,000 mark. So despite it's obviously got some really good qualities that we've just discussed here, we still don't think it's probably reached its potential. It's still got a bit of a relatively sleepy feel to it, particularly relative to other suburbs within the inner city areas of Melbourne. So there's a bit of potential there. One of the things that does hold the suburb back, though, is that it does probably have a bit of a lack of choice from both a public and private secondary education facility. It is fairly close to Moonee Ponds, though, and you do have some good options up that way, just a little bit further north. From an investment perspective, there's obviously good quality 2-bedroom cottages, terrace houses for around $900,000, and from an apartment point of view, it's probably around the mid 500s and up to $600 for a really good one. It's definitely a cheaper alternative to, say, a North Fitzroy or a North Carlton, and it's actually a relatively similar distance to the CBD. I'm not by any means suggesting that they're going to close the gap, but it wouldn't surprise me if it does narrow slightly, just because Ascot Vale does have a lot of things going for it. Okay, so let's move on to our second suburb for today. We'll have a chat about Thornbury, as you can see on the map. So now Thornbury's 7 kilometres northeast, or slightly northeast of the CBD. In terms of location, it's bordered by Darebin Road to the south, Dundas Street to the north, Mary Creek to the west, and Darebin Creek to the east. Similar to Ascot Vale, it was also established in the 1880s, and the population grew significantly off the back of the local brickwork industry and also the gradual introduction of the railway line through the area. If anyone knows Thornbury at all, it's not hard to see when you do go why the residents do rave about it. It's really close to the CBD, and access to the CBD is fantastic. Very, very well serviced by public transport from both the train, 2 tram lines, and city's not too bad either, although getting through the Fitzroys and things via roadways can be a little bit tougher. From a village perspective, Thornbury Village, which is situated along High Street, is developing more and more, and it's not dissimilar to Ascot Vale, particularly over the last 5 to 10 years. It's really gentrified. Thornbury residents also have good access to Northcote Plaza, also to Northland Shopping Centre up in Preston. So you've got a number of options that way as well. And there's good local schools, and also medical facilities fairly close by in Fitzroy, Parkville, and also up in Heidelberg as well. Median values here, their house price is up around $950,000. That's certainly taken a jump, I think, in the last, Thornbury particularly in the last 12 months has performed quite well. People are starting to realise what we've known for a while, that it is very, very well serviced and has a lot of good quality period homes. Comparatively though, if you look at its cousin or sister suburb just south in Northcote, the median price there jumps up to $1,070,000. So although you still really have the same level of service in terms of shops, public transport, that sort of thing, you're only 5 minutes further out. It certainly is a much more affordable option for a lot of people. And once again, from an investment perspective, there are certainly pockets that have greater levels of demand across the suburb. The closer generally you are to High Street, so to that village, and also to the train line, that runs between High Street and St George's Road, the better off you'll be. There are still some really good pockets though over in the western section, over towards Merri Creek, particularly from a home buying perspective. But you do have to be cautious over towards Merri Creek. There are still a couple of pockets of industrial areas in and around there that you just need to be cautious of. And if you do move too far towards the eastern suburbs, or eastern side, sorry, of Thornbury, it tends to get a little bit further away from that village and also from the public transport the suburb offers. The one other thing that I would mention about Thornbury too is the consistency of streetscape. It's been developed and had a lot of properties renovated and not necessarily in keeping with the style of the property, and also family homes constructed, particularly during the 50s through to the 1980s, and they're not always in keeping with that period style. So having a good look at the consistency of the streetscape in a suburb like Thornbury is important. You do need to be a little bit more flexible though, because it is a bit more of an eclectic suburb. So it can't be row after row of terrace houses that you might expect in another suburb, say like a North Carlton, that type of thing. Okay, so let's move on to the third undervalued suburb for today. And I will make a declaration off the top here. We're looking at Coburg. It's a fantastic suburb. We've bought properties in there over the years for numerous investors. We don't buy in there a lot, and there are a number of reasons for that, and I'll go through those as we go through the details of the suburb. Coburg is approximately 8 kilometres north of the Melbourne CBD. Fantastic public transport linkages again via the train line, the upfield train line, and also tram lines up Sydney Road. They're not ideal, the tram lines up Sydney Road, just because obviously it gets fairly congested. There is the tram that goes through Royal Park and up Melville Road, which would be on the western boundary of the suburb. It's probably more of a Brunswick West, but it's still something for those in the western section of Coburg to utilise as well. As a suburb, it's bordered by Moreland Road to the south, Gaffney Street and Murray Road to the north, Merri Creek to the east, and it's roughly Melville Road and Sussex Street to the west. It's just not exactly a straight line. Select parts of Coburg have shown really good levels of demand over a long period of time, and particularly being south of Bell Street is important because you really get then the benefits that, say, Brunswick has. There are a number of, it's a bit like Thornbury in that there's been a lot of development over the years in and around the area, period homes being either knocked over with brick veneer houses in the 50s, 60s being constructed, or even period homes being bastardised over years and not being renovated in keeping with their period style. And that's one of the big problems that we do have with Coburg. Consistency of streetscape's a really difficult thing. And also, it is moving into more of a family home type suburb. So there's a lot more larger homes as opposed to the single front traditional 2-bedroom cottages, terrace houses that work really well from an investment point of view because they are low maintenance and ideal from a tenant side of things. So great suburb, but very, very particular. You have to be within reasonable proximity to Sydney Road and to the train line. And the further south you are, the better off you'll be. Which then brings us to our final suburb for today, which is Seddon. Now, again, just to give you a disclaimer up front, we currently don't purchase investment properties in Seddon, but it is very much a suburb that we keep a close eye on because there are a lot of attributes that Seddon offers that work quite well. It's 6 kilometres west of the CBD, situated between Footscray on its northern boundary, Yarraville to its south, and Maribyrnong River to the west. It's serviced by a number of roadways, Footscray Road and Dynon Road in and out of the city. They can get a little congested, but they certainly do offer access into the CBD. And obviously Williamstown train line runs out that way. It contains pockets of some really, really good quality period style homes, both of a single and double front style. And there's a particular focus on weatherboard cottages in and around the suburb. It's got a very good feel to it in terms of tree-lined streetscapes. It works really well and is quite attractive. And a particular pocket that we really do like is in the southwest corner of the suburb, and it's bordered by O'Farrell Street, Gaiman Street, Charles Street and Williamstown Road, and it's especially good in that sector. As a suburb, it does resemble the better pockets of Yarraville, but it probably just hasn't quite been as popular for as long as what Yarraville has. But you certainly could argue that with the vast improvement that the retail sector has had and the village atmosphere that Seddon now offers, and obviously its closer proximity to the CBD, that it is almost a better option from an investor's perspective than perhaps Yarraville might be. I've mentioned Seddon's quality transport links. The addition of the Western distributor in a few years could even open up and revitalise the area even further, which is certainly a positive. The proposed tunnel, the aim is to take transport out of the inner west. Now, this will mainly benefit Yarraville, but it should have a flow-on effect to Seddon as well. But do remember, as we discussed earlier, around the hotspot discussion about overhyped roads, so don't put too much weight on the impact of the Western distributor when you are making your decision about where you'll invest. And as a background, median house prices for Seddon are around 818,000, so certainly a bit of a more affordable option. But that section that I mentioned in the southwest corner, that's certainly one of the stronger points. So I would suggest that the median house price might be slightly below that area. So that's a bit of an overview. Now I'll hand you back. Stuart's going to now take us through a few things from a financing side of it.
Thanks, Jarrod. And just as a reminder, if you've got questions, keep them coming through, because I'll only sort of take up about the next 10 minutes or so to go through my presentation, and then we'll love to take the opportunity to answer some of your questions and make sure the really difficult ones are aimed at Jarrod. Either way, I'll ask Jarrod the difficult ones, so it doesn't really matter. Today, I'd like to talk about the financing and, I guess, financial planning considerations with respect to implementing undervalued suburbs or hotspot suburb strategy. And I'm going to make a couple of assumptions in regards to the information I want to speak about. And the assumption will be that you're interested in this strategy for either of two reasons. One, that you've got a low asset base or limited amount of surplus income, and you'd like to build wealth quickly, or secondly, you feel like it's a good strategy. So it's a superior strategy than, say, buying into an already proven suburb. What I'd like to cover is a couple of different points. I'm going to talk a little bit about managing your borrowable equity. With the property market in recent times, there's been plenty of, I think, really good transactions, particularly in parts of Melbourne, that it's a great time to lock in your borrowable equity. So I want to talk about that and how that links into buying an undervalued suburb. If you do have limited capacity and you're thinking, well, I can't afford to get into an established suburb, so if I can identify something that's a little undervalued, maybe that'll meet my financial capacity. Well, another option is to co-invest with either a family member or a friend. So I'd like to talk about that. And then if you're of the mind of thinking that it's a superior strategy, so it's not really a limitation of finances, it's more about strategy, I'm going to talk about what if you're wrong and you're either too early into the suburb, or the growth isn't perpetual, so you only get a spurt of capital growth, and the long-term impacts of that. And lastly, very quickly, I'll talk about the merits of borrowing more than 80%, which is kind of linked to maximising your borrowable equity. Which is a great segue. So borrowable equity is quite different to theoretical equity. Theoretical equity is obviously if you went and sold the property, net of sale costs and repayment of loan, and capital gains tax, what cash would you end up with, and that's the equity in your property. Borrowable equity is more important, arguably, because it allows, if you maximise it, allows you to build your property portfolio quicker, firstly, and secondly, in a manner that's arguably safer as well. Borrowable equity is really how much equity can you pull out of a property, that is, borrow against the property, and it's going to be determined obviously by your financial situation, so your own personal borrowing capacity, but also, and I think this is the thing that typically restricts people the most, is the bank's valuation of your assets. So really how much the bank thinks they're worth, and therefore how much they'll lend against them, which is normally 80%, and I'll talk a little bit more later on about that. My view is that investors should proactively manage their borrowable equity. That is, proactively go and increase their limits to 80% of their current values on a regular basis. Even if you don't necessarily have any intention to invest in the shorter term, sometimes waiting until you're ready to invest isn't necessarily the best time to go back to the bank and increase limits. So some of the benefits of doing that is that firstly, you're investment ready. You lock in access to another deposit, or monies to contribute to other investments if or when you're ready to do so. Secondly, you reduce your risk because it's counterintuitive because obviously borrowing more arguably extends your risk. But if all you're doing is increasing your limits and not actually drawing down, what means you've got larger buffers in place. So if something goes wrong, interest rates increase and so forth, you can sort of weather that storm. And thirdly, is you should take your borrowing capacity when it's there and it's offered. Things change. Certainly, credit policies change significantly over the last 12 months. So if you're in a financial situation that allows you to lock in those higher limits, you should take it because who knows what happens tomorrow. The problem, however, comes with managing borrowable equity is if you're investing in an undervalued suburb, what happens if the suburb continues to be undervalued? So obviously when a bank comes to value your property, they'll look at comparable sales of similar properties in a similar location to yours. And as I said, if it's continually undervalued, then your bank valuation will be arguably undervalued. And we all know that bank valuations are quite conservative. So arguably you won't have enough borrowable equity to leverage off to help you build your portfolio. Just a 5-year delay, if you're 40 today, a 5-year delay in adding another property or your first investment property is going to cost you about $745,000 in equity by the time you get to age 60. And it's that 5-year delay because of the compounding nature of growth. So it doesn't mean we need to urgently go and rush out and borrow to our eyeballs, but it's about being strategic when managing your borrowing capacity. So what happens if you're in a situation where by yourself you can afford to, say, invest in a property in the sort of $300,000 or $400,000 range, and you realise, or you're starting to realise, you're going to compromise on the quality of the property if that's your budget. One option available is to go and co-invest with a friend, either say a sibling, for example, or a close friend. And doing that might help you aggregate your borrowing capacity and then therefore get you into a different price bracket. So maybe then together you can afford to invest in a property, say $600,000 to $700,000. And if you did that, you would arguably reduce your investment risk because you're investing in a better quality asset. And secondly, the aim is to obviously increase your overall or longer term return. So there's a couple of warnings about doing this. The first one is typically, I've been doing this for about 14 years now, and I've come across lots of different scenarios where people have co-invested. And I think the best advice I can give you is approach it like it's a short-term solution. So maybe around sort of a 5-year period. It's unlikely that, for example, if two siblings invest together, that they're going to be co-own the property for the next 30 or 40 years. More likely what's going to happen is that their lives will move in different directions at different stages, and each will want to utilise the equity or access the equity at different times for different purposes. So if you approach it like, hey, let's go and buy this property together, if we build some equity in the shorter term, and then if one of us buys each other out, or we sell the asset, or we just have a think about what those exit strategies might be if your situation does change in the shorter term. Now, I'm not suggesting you go and buy a property and own it for 5 years and sell it. In fact, if that was your strategy, I'd say that's too risky. You need to have a longer time horizon. It's really about the longevity of the co-ownership rather than necessarily the property ownership. My second point would be to sort of document your expectations, and it's really linked to my first point, is to talk out what all the issues could be. What if someone loses their job? What if someone wants to access the equity, and so forth? If you discuss these things up front, then you're more likely to avoid any problems later on. Be aware of joint and severable liability. What that means is that if I go and apply as a joint borrower on a loan for, say, $200,000, and I want to co-invest with a friend, and my portion is obviously only 50%, $100,000, I'm actually still on the hook for the full loan, for the full $200,000, and that impacts my personal borrowing capacity. So just be aware of that. Now, there are some lenders and some products that can limit your liability so that I'm therefore only liable for my $100,000. So get some advice in terms of that, because that could impact your longer term plans. And lastly, I'd say that money changes many relationships, particularly in family, but with friends. So be really mindful of that. Again, if you can approach it like an investment, a business transaction, you'll be well rewarded for that. So the next slide, what I'd like to address, in the next couple of slides, what I'd like to address is investing in a hotspot as a strategy, as opposed to the alternative strategy, which is to invest in a proven suburb. And the next two slides, what I'd like to demonstrate is the risk of either being too early or the growth not being perpetual. So the graph on this slide shows that what happens if we invest in a suburb and the performance is pretty poor for the next 10 years because we're a little bit invested a little bit too quick in this suburb, whereas the opportunity cost would have been to invest in a proven suburb. And so the graph here shows that the hotspot, which is the blue line, only grows at 3.5% per annum for the first 10 years and then grows 7% from beyond that, whereas the investment grade proven suburb, which is the green line, grows at 7% per annum right from the beginning. And as you can see, there's about a growth gap in 30 years' time of about $1 million. So you're $1 million worse off. But it's actually worse than that because by the end of year 10, the investor, the green line, the investor that's invested in the investment grade suburb, actually has $250,000 more borrowable equity than the alternate investor. That's another deposit for another investment property. So if you then add another property in that scenario for that green investor, the compounding effect will be massive at the end of the day. The second scenario I'd like to talk about is what happens if growth is not perpetual, which I think is probably a significant risk for people that are trying to pick the next growth suburb. So when I say growth is not perpetual, what we want to do is invest in assets that give us a strong amount of capital growth on average over the long period, not just the short term, because we're buying property and we want to hold it hopefully for the long term. So what this does is the graph does is assume that the hotspot grows at 7% for the first 10 years in equal line with the proven investment grade suburb, but then peters out and only grows at 3.5% from there on. And as you can see, the growth gap in this situation is nearly $1.9 million after 30 years. So it's really important to invest in assets that have the quality to give us that perpetual growth. And remember, these assets cost the same in terms of the same deposit, the same cash flow, the same stamp duty, but certainly the growth is significantly different. So my view is that with an investment strategy, you want to achieve the highest return for lowest risk. And investing in a hotspot actually adds risk into the strategy and doesn't necessarily compensate you in terms of a higher return. The last thing before we get into some questions, and I see them coming through, so please keep firing them at Jarrod, is I'd like to talk about borrowing more than 80%. So before I get into the guts of this, if you borrow more than 80% of a property's value, you typically have to pay for what's called lender's mortgage insurance, which really protects the lender's risk if you default and there's a loss. They go and sell the property and it's not enough to repay the loan, they insure that loss. So it doesn't protect you, it protects the lender. And what you need to do is you need to pay a one-off cost for that. So it's just a once-off premium. Part of that premium can be added to the loan, and you can see on the table in front of you that the cost of mortgage insurance ranges from sort of 2 to 5%. Obviously, the more you borrow and the higher the loan, the higher the cost of mortgage insurance. If you've got limited deposit or limited equity in your existing properties or cash, one of the questions you're going to have to consider is, should you buy now and pay for mortgage insurance, or wait and save some more money or wait some more time for your properties to appreciate in value? The way I look at it is that mortgage insurance is really just a cost of doing business. It's a cost of borrowing, it's a cost of investing. And you just need to consider how long will it take for you to avoid mortgage insurance, so either save some more money or get some more equity in existing property versus the cost. Remember that mortgage insurance is tax deductible, so you can claim it over the first 5 years of a loan. So that sort of offsets some of the cost of it. But if it's going to take you, say, more than 3 to 6 months to save a deposit and you're going to pay, say, 2% in mortgage insurance, then you might be better off paying that 2% and buying today, because waiting another 12 months, you could end up paying a lot more than 2% for the same property. So managing borrowable equity also involves considering the cost of paying mortgage insurance. Okay, so that ends our presentation. Now what we'd like to do is turn to some questions. And at the start, we asked you to sort of type in some questions, so keep doing that. Jarrod, the first question is for you, and this is from David. As a novice investor, is there any way for him to determine how do you find or identify an undervalued suburb?
Hopefully, David, some of the information that I provided earlier should answer some of those questions, but it's definitely to still look for the fundamentals that make it a good investment location. So being within reasonable proximity to a local village of some sort, being within reasonable proximity to public transport, but relatively perhaps a cheaper alternative to, say, a neighbouring property that offers similar type attributes, but perhaps isn't quite, but is a bit more expensive. So if it gives you a bit of an idea that that's the sort of thing that we would be looking for to determine that perhaps this property's got a bit more growth within it. To not necessarily catch up to a neighbouring suburb, but to certainly close a gap. And I certainly think some of the ones that we mentioned, particularly today, will give you that sort of an understanding. That's definitely the starting point anyway.
Jarrod, another question that a lot of people have been asking, and I'll just sort of summarise it in one question. Where do we draw the line when it comes to a sort of hotspot versus a proven suburb? So, for example, if we're looking per annum, and I was just saying, okay, well, I can buy a decent unit for around 600,000 in per annum, but if I go across Dandenong Road into Caulfield, I might be able to get a similar asset, but only for 450,000. So if I'm an investor considering, do I buy in a suburb that hasn't yet, use the term boomed, or do I buy in a proven suburb? At what point does the undervalued suburb become proven?
It needs to have a consistent track record, Stuart, of showing it over a period of time. It can't just be something that, it's a cheaper alternative, I'll go with this one, because exactly for the reasons that your graphs just showed, that gap needs to we don't want that gap getting too wide because you've tried to predict something too far out. So you don't want to be, but using, say, that Paran Caulfield as an alternative, I mean, 600,000 for a good quality 2-bedroom apartment in Paran versus, say, 450. Now, I think 450 is going to be a stretch to get something in Caulfield that's of quality these days. And what you do tend to find with suburbs like this is that what you'll get in the form of a 2-bedroom apartment in Paran will be a lot smaller than what you'll get in the form of, say, a 2-bedroom apartment in, again, Caulfield. Caulfield tends to have larger apartments, smaller blocks. So price-wise, they're actually not that different. So I would say it needs to be over a proven track record. That's how you'll get. That's how you'll differentiate between a hotspot versus an undervalued suburb.
Thanks, Jarrod. James and Matthew have actually asked a question in respect to townhouses, and I know that a few sort of up-and-coming suburbs, if you call them, start to have more townhouses built in them, and they're being sold as an investment, as opposed to the proven suburbs, if you like Parans and South Yarras and so forth, have a whole lot less townhouses in them. What's your view with respect to townhouses in those sorts of suburbs versus the alternate, which is investing in a proven suburb? Townhouses,
they're quite good from an owner-occupier's perspective. Generally, from an investor's perspective, though, for a developer to be able to have access to land within one of these more established type, even an inner to middle ring type suburb, it tends to be more of a secondary location. So it's generally not going to be in a prime residential area that's got a period streetscape to it. It tends to be more of a secondary location. The other thing is that there's more and more of that type of property being constructed. So the scarcity value that you tend to look for to prove for capital growth focused properties generally isn't there with a townhouse. So I'd probably still tend to steer clear of it.
Jarrod, Anne's asked, which is a better strategy, buy an undervalued suburb and renovate now, or buy, say, in North Carlton and plan to renovate in a few years' time if you're able to do that?
Look, and if we're talking about a property that is, when we say renovate, from an investment perspective, you don't want to be changing the structural nature of a property. So when we talk about being prepared to renovate to our clients, we tend to talk about cosmetic type works. So putting in, upgrading kitchens, upgrading bathrooms, paint, carpet, window furnishings, those sorts of things. But actually changing the structural nature of the property is generally not advisable. So if we go down the track of just more cosmetic renovation type works, if the capacity's there, I would still buy in the North Carlton type location because you're in an area where the demand is still going to be stronger and will continue to push longer term. But what I wouldn't do is just buy in North Carlton for the sake of buying in North Carlton. So if you're having to compromise in order to get into that suburb by perhaps buying in a secondary type street or on a main road, or perhaps even a property that doesn't have a great floor plan and is going to take some significant work, then I would much prefer to see you buy a high quality property in an A1 part of Thornbury than a secondary, perhaps not quite as good a part of North Carlton. All right, my turn to fire one at you now, Stuart. I've got a question here from Liz. It says, how do you go about expanding your property portfolio when investing in the particular areas that we've talked about today, which have capital growth focused, but not necessarily high yield? So we will likely be having to negatively gear. What if you're asset rich, basically, but cash flow poor? How do you still buy property?
Thanks, Liz, for the question. Firstly, a couple of comments. Firstly, good quality investment strategies require time and patience. So you can't necessarily do things overnight, and good quality assets need to have the time and space to be able to perform. Secondly, of course, what we're all trying to do is invest to secure our financial future and hopefully fund a comfortable retirement. To fund a comfortable retirement, we need passive income to replace our earned income. So we need our assets to generate a whole bunch of income, obviously. One of the misnomers or mistakes that people make is that they start investing for income right from the beginning of their investment journey, which is going to be a really difficult strategy because obviously we give half or nearly half of it away donated to the government in the form of tax. So we've got a lot less to reinvest each year. A much better strategy is to try and to do it in sort of two steps. And the first step is you need to build your asset base, so your net worth. And then secondly, once you've got a strong net worth, then you start tilting your assets towards generating more income. So if a client works in my office and says, Stuart, look, I'm 60, my net worth's 500,000, I need you to develop a strategy to fund the rest of my life, which could be another 30 or more years, that's going to be a challenge. But if someone walks in and says, Stuart, my net worth's $3 million, build me a strategy, that's a whole lot easier. So really what you need to do is just take a deliberate approach and make sure that the assets that you do have are going to perform well in the long run. And then it's just about slow and steady wins the race. I'd much rather have one fantastic asset, so property, and hold on to it and nurture it rather than have 3 average assets. You're never going to get anywhere. Ultimately, the power of compounding growth will in time make your debt and your income position look immaterial. So it's really more about patience than doing everything. Jarrod, here, a question on the slide here from Simone. Where can I buy a good quality house for $750? And if I add to the question, and we're really keener to buy a house rather than an apartment because we think it has land value or more land value, I'd be interested in whether you should spend that $750 on a house or should you put it into a unit.
It almost comes back, Simone and Stuart, to the brief discussion we had earlier about buying whether you should go North Carlton or Thornbury. It's buying an investment property. It should always be about buying the best property you can and not necessarily putting any preconceived ideas into that. So to get a house, to be honest, at $750,000 in the current market is going to be very, very difficult. To get it in one of the inner sort of suburbs where you'll get strong levels of demand from both a purchasing perspective but also from a tenancy point of view. At $750,000 for our clients at present, I would be suggesting to buy a high quality apartment. Again, because I can get something in an absolute blue chip suburb that will have consistent levels of growth. But the thing that people quite often forget or don't necessarily understand with apartment purchasing is that with the older style apartments in the low rise type blocks, there is a very strong land component to your purchase price, and that is what will drive the growth. So if you're in a block of say 10 apartments, 1/10 of that site, subject to the unit entitlements with the certificate of title, you own 1/10 of the land there. Now, it doesn't have a physical aspect of when you buy a house, this is my land, but there is a notional component there, and that's what will get you the capital growth. So to buy a house, a pure house at the moment for $750, you'll be going a lot further out, and you'll tend to be more of in an owner-occupied type location. You then tend to find from a tenancy perspective, you have greater vacancy periods. There's a lot more maintenance associated with that type of property, which tenants aren't always prepared to do. So there can be more costs associated because in some cases you may have to pay for a gardener to maintain your property on an ongoing basis. So I would much prefer to see someone at that sort of price bracket buy a high quality apartment and go down that track.
We've still got about 15 minutes to go and we've got plenty of questions to get through, but if you've got some more, certainly keep typing them in. Another one for you, Jarrod, a really easy one, just a bit of a rundown of these following suburbs that clients or listeners have asked about.
Okay, so let's start from the top. Williamstown, fantastic suburb, great owner-occupier type location. It's just a little bit further away, difficult to access from an investment perspective. I would be more than happy to live over there myself. It's got a real village type atmosphere to it, and it's got a great feel, but it is just that little bit further away, hard to get to. Footscray to a certain extent doesn't have, in pockets it does have some period homes, but there's also other pockets that don't necessarily. It's probably still going through a gentrification process, and accessibility to the city is not great. So that's probably something from a purely investment perspective, it's a little bit harder to access. If you look down in Bayside suburbs, Elwood, great spot, some really good apartments, Art Deco, 50s, 60s apartments in and around there. You do have to be careful in Elwood as a suburb because it was built on a former swamp. So there can be some underpinning issues down that way. So you do have to be careful what sections of the suburb you do and don't buy in. Hampton and Sandringham, again, great owner-occupier suburbs, but far less property in those areas that is in the context of, say, single front period homes or perhaps even older style apartments. They tend to be more family home type locations on larger parcels of land. The northeast suburbs, Jennifer, it's fairly open to interpretation how far out we go there. But if we look at, say, suburbs like Fairfield, Alphington in the inner city, and then perhaps even parts of Ivanhoe from an apartment point of view in Eaglemont, there's some good pockets there. If you start to go too much further out, you move into, say, Templestowe, Doncaster, Bulleen, and they are very much more owner-occupier type locations. And the one thing out that way, which most people know about, is that the public transport linkages out into those suburbs, it's a bit of a black hole. So that's one issue from an investor's point of view. Elsternwick and East St Kilda, they're great suburbs. There's some really good public transport linkages in and out of the city in terms of trams and trains. Period homes are very good, and there's some really good quality 50s, 60s, 70s era apartments in those that work quite well. Moving further out, Melbourne West, so Diggers Rest from Glen. Again, more of an owner-occupier type location. The consistent levels of demand out in that sort of an area won't drive capital growth quite as strongly as what they will perhaps in inner city areas where you do have a bit more scarcity value.
I'll add another one there, Jarrod. Well, actually, James did. We know they've got the best football team in the AFL, but what about Geelong as a location?
I won't dignify the first part of that question with a response. Geelong, if you look at say regional cities as a whole, so let's look at say Geelong, Ballarat, Bendigo, and group them all together. If we get clients that come in and suggest they'd like to buy an investment property at around the mid 300,000 type mark, and they adamant they want to buy property, well then I would prefer to see someone go to a Geelong, Ballarat, Bendigo type location as opposed to buying in a house land package type new estate on the fringes of Melbourne, because you still do have attributes of scarcity value in those locations. Now, the capital growth won't be anywhere near as strong because the demand push factors in a regional area aren't as strong as what they are in Melbourne. But you can definitely use it as a stepping stone because the yield will be certainly better. And you can use that then as a stepping stone to get into the Melbourne market to get something that's going to perform at a greater level.
And Stacey's asking about Frankston. I know we talked about this just before the webinar. It's been touted as a sort of next growth suburb, I think, ever since I started ProSolution back in 2002. So we're all waiting with bated breath. But what do you think about Frankston?
I think that's the key, still waiting with bated breath. It's again, fantastic from an owner-occupier's perspective. There's a lot of lifestyle issues that work quite well down that way. Very easy to access the Mornington Peninsula, and we all know what that has to offer. But in terms of consistent levels of demand to really push capital growth, there's certainly a lot of scope for development as you move slightly further down the peninsula. So there's the land accessible and available to a lot of people means that the growth is highly unlikely to be as strong as what it may be in other parts of Melbourne.
Awesome. Well, James has a question he sent through when he registered for the webinar, and it reads, what effect might a general burst of housing prices have on these identified areas over the short to medium term? And I'd be interested in your response, and I certainly can add some comments from a risk investment perspective.
Well, given that they're in areas that have shown consistent levels of growth, we just feel as though a lot of them are slightly below where they should potentially be. This will more than likely bring it up to an acceptable standard, but we would still expect them to continue to perform well over the longer term because they do have those underlying fundamentals that drive capital growth in terms of all the attributes we've spoken about today. Public transport, village atmosphere, strong land value, scarcity value to the property. All those things will continue to drive them further into the future.
And James, just to add my comments, we're also talking about the upside, but what I'd like to consider is the downside. So in a rising tide, all ships rise, but putting the question differently, what happens if there isn't a general rise in housing prices? And I guess that's what attracts me to advising my clients to invest in the more proven areas, is that in a slower market, they should still continue to perform and, most importantly, outperform lesser quality suburbs. So certainly if everything's rising, that's great, but in situations where we've got a bit of a tighter market, or if we go into a phase of low interest rates and therefore low inflation, then the quality of our assets will very much determine our outcomes. And so we can kind of flip that question around. Jarrod, I've got a really scary question here from Tim. Dockland apartments versus CBD apartments. It's like choosing, would you want to be a Collingwood supporter or an Essendon supporter this year?
No, it's nothing like that. But I would not be going down either of those paths, Tim. They're both in the same part, in the same box, in that the supply levels for apartments in the CBD and Docklands at the moment is ever increasing, and there's certainly by no means any sign of that finishing. So the total lack of scarcity value in those sectors means that I would be steering well clear of both those types of properties.
Another question about hassle land packages. A lot of these are being marketed to investors, and I've certainly got some experiences of some clients of mine that I can share. But what's your view on hassle land packages, Jarrod?
So in terms of your question there, Manuel, the house land packages, to get a house land package in the undervalued suburbs we've discussed today, is near on impossible. And the main reason for that is they're in areas where land is highly, highly scarce and very hard to find. So you really can't buy a house land package. There's certainly still opportunities to buy existing freestanding homes, as we discussed, the single front period type homes. But coming back to your question there, Stuart, in terms of a house land package, they more often than not are in residential estates on the fringes of Melbourne, or on the fringes of whatever city you might be looking in. And as a result, whenever a development or whenever demand even gets remotely close to meeting the supply levels that are around, there's generally another land release that will come along. So the potential for capital growth is almost non-existent because this supply level is never ending.
I can share some experiences with some clients, certainly contrary to our advice and caution, that have purchased or invested in properties in the sort of Point Cook area and those sort of surrounding suburbs. And they're quite heavily marketed by some, I was going to say financial advisory firms. I really wouldn't call them that. All they are is really property marketing businesses. Which is a massive caution. If someone tries to sell you a property, make sure they're not receiving commission on the other end. And they just don't, they haven't worked, and they don't work, and they'll never work just because there's no scarcity, as Jarrod's talked about in terms of land supply. The architectural style there's nothing unique about it, and there's no proven performance. So they haven't demonstrated the capacity to be able to deliver strong capital growth. So I'd steer well clear of that, but most importantly, a big caution, don't receive investment advice, that is, where should I put my money, from someone that has a vested interest in the outcome.
I've got one here for you, Stuart. Comes from James. We wish to buy an investment property, in brackets a villa unit, to hold for at least 20 years, possibly with the view to potentially retiring in when we downsize from our family home. Is there any advantage or disadvantage in having the property owned by a company we already have established and that has some available funds so that the company may become an investment vehicle?
There's very little advantages by using a company. In fact, unless you're doing property developments, typically personal name, super fund or trust is the better ownership structures. The problems with company are tax inflexibility. So obviously you've got shareholders of the companies and those shareholders have to, depending on their proportionate shareholding, accept the income and capital gains from whatever that property generates. But the biggest problem with owning inside a company is you don't get the 50% capital gains tax exemption. So your capital gains will be taxed at 30%, whereas if you put it in a trust or in your personal name, you'll get that somewhere between 20 and 25%. So you'll end up paying a lot more capital gains tax. So certainly avoid doing that. Look at ways to try and get the money out of the company. And there's obviously a few ways to do that, but you'll need to get some tax advice. Okay, unfortunately it looks like we've run out a bit of time, but thank you very much for spending your lunch hour listening to us this afternoon. On behalf of Jarrod and myself, we really do appreciate it. If you didn't catch everything, that's okay. We'll send you a recording in the next couple of days so you can enjoy a family evening listening to us, perhaps. As you log off, you'll receive a very short survey just seeking some feedback this afternoon. Really appreciate it if you just take 30 seconds to do that. Otherwise, thank you very much.
Thanks very much.